When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave Chase and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
I'm Ron Stutz along with Chase Lopez today. And Chase, how's it going?
Going great, Ron. Going great. Thanks for that kind introduction. Looking forward to getting this information out to all the listeners today.
We're going to talk about some really interesting things today. On this particular podcast, we cover a lot of general subjects surrounding retirement. But today, Chase is going to lead us on a sort of deep dive into one specific investment tool, structured notes. I don't know about you as a listener, but I have heard this phrase more and more lately, and I'm really excited to learn more about what structured notes are and how they work. So, Chase, let's dive right in, buddy. What are structured notes?
Yeah, so really what the listeners before we jump into it, deep dive, like you said, Ron, this is going to be a little bit more of a granular podcast, right? So we're going to focus specifically on the structured notes, how they work, the advantages, the disadvantages to a tool like this. And you'll notice that I mentioned this, multiple times as we go through everything, but today is very much so just an introduction, right? Mm-hmm. So we encourage everyone out there, if this topic interests you and you want to speak with us a little bit further about it, you can just give the office a call, and we're happy to dive into the details and see if a structured note would fit your plan, right? Because it may not be for everyone, and that's what we'll kind of walk through today.
Well, structured notes may not be familiar for everybody, so why don't you start by giving us a definition and explain what structured notes are, in the first place.
Yeah, no, absolutely. So structured notes, they're just investments. They're issued by banks and large financial institutions. And ultimately, they're really designed to give investors some level of downside protection. Now, that can be customized, right? So really the whole idea is, hey, I want some protection in my portfolio, right? Protection from, some sort of stock market loss. Traditionally, they're used by institutional investors, which just means, large investors like banks and things like that. But more recently, they've been opened up to the general public, and you can really get, exposure to these really only through a financial advisor. So if you go on to, if you have Charles Schwab or an E-Trade account or something like that just on your own, most of the time you're not able to have, access to these tools. Yeah. And the reason is because, they really want to make sure that the customer fully understands, what they are and kind of all of the complexities involved with them.
Well, that certainly makes a lot of sense, and certainly there's a lot of use for structured notes in financial markets. Tace, can you give us some real-life examples of when somebody might use a structured note?
Yeah. So like any investment, right, whenever we're talking, investment plan or anything like that with a client, we always talk about diversification, right? And structured note is just one piece of your overall puzzle. So most of the time folks have, some money in the stock market, some money in in bonds, or, maybe some other investments as well. Structured notes is just a piece of kind of your overall puzzle. Mm-hmm. So, a structured note in its most, basic form, it has a few different components, right? It's not just, a stock, Apple stock as an example, right? It's not just a stock that you see go up and down. It has a few different, components involved with it. The first is that it is for a certain time frame, right? So a structured note can be structured, for as short as, 6 months to a year, or as long as 5 years, right? So it has, a term associated with it, and it matures at the end of that term. Much like a bond, right? If you have a 10-year bond, at the end of 10 years, you get your money back, and you would have collected interest over that time frame.
Right.
A structured note works the same way. It has a kind of a term in which it's going to be active for. And unlike, stocks or bonds or anything like that, it is directly linked to some sort of underlying asset, as we call it in the industry. So, for example, it can be linked to, just the market in general, like the S&P 500, or it can be linked to an individual stock. I used Apple as an example earlier, right? So you could have, it could be linked to, the price of Apple stock as well. And like we alluded to before, right, it has some sort of protection on that, whether that be, sometimes, the way the structured note is set up, they might say, hey, we will protect you from the first, 30% of downside of whatever that underlying asset is. So if we go with the, S&P 500 example, right, they say, hey, we will protect you from the first, 30% that the market is down. So if the market's, down 28%, then your investment is still protected, right? It offers that kind of protection.
Yeah.
And then in exchange for that, you get some sort of return or some sort of payoff, right? So sometimes they might say, hey, you collect some interest over that time frame, or you might get some of the growth inside of that index. But it's really important for folks to know there are, multiple different, components to each structured note, and everyone is a little bit different. So that's why, if you ever want to, see if this will be a part of your plan, we always recommend getting with a financial professional to make sure, it's going to fit your plan the best.
Thanks for explaining all that, and you're doing a good job of explaining it so far, and I'm still with you at this point. So how do we go about determining if this might be an attractive solution in our own lives and for our own plans?
Yeah, so the first thing that you kind of want to ask yourself as an investor, if you say, hey, maybe this structured note would be a good fit inside of my portfolio, right? Is you want to say, hey, do I have enough diversification inside of my portfolio? So most people, right, if they're in, using their 401k as an example, they have some in some stock mutual funds, some in some bond mutual funds. And that's really it for most folks, right? So this is just another way to just get another, piece to that added to your overall investment plan. And also, if you think, hey, I'm not 30 anymore, right? We're approaching retirement. I want some protections here on my money as I get closer to retirement. Then this can be, a great tool for that. And also, continuing to grow your money.
We're exploring the topic of structured notes today on the Retire Your Way podcast with Chase Lopez. I'm Ron Stutz, and as we move along, I'm beginning to understand this a little bit more. Talk about some of the potential benefits and risks of structured notes, if you would, and for investors, and also potential risks associated with structured notes for us as individuals, and how to mitigate those.
Yeah, so we did a good job of talking about, some of the advantages, right? Advantages being, we have protection, as opposed to if we are just in the stock market, there's really no protection in that type of scenario, right? Like any investment out there, there's trade-offs, right? So there is also some, to your point, some risks involved with these structured notes that you just want to be keenly aware of. And, again, I know I sound like a broken record, Ron, but just you want to run by it with your financial professional to make sure that you're kind of all on the same page. But one of the big risks or big, disadvantages, I guess, for lack of a better term, with a structured note is the time frame at which you have to hold it for, right? So we talked about that earlier, where it can be as low as 6 months or as long as 5 years. During that time frame that the structured note is in place, it is pretty much locked in, right?
Yeah.
So similar to if you go to the bank and get a CD, let's say a 5-year CD, right?
Yeah.
The bank will say, hey, the trade-off here is we'll give you a little bit of better interest than if you just leave it in your bank account, but we are going to hold the money for 5 years, right?
But you don't have the liquidity.
That's exactly right. That's exactly right. So that's one risk. And then another risk is that, these are, of course, offered by large institutions like banks, as an example. Now, these are not offered by, your local credit union, right? These are very large worldwide banks. So think, JP Morgan Chase, Bank of America, Barclays Bank, very large institutions offer the structured notes. So you just want to be aware that, hey, this is in fact a note, and a note by definition is an IOU, right? So much like a bond, if you hold a bond for a certain company, it's just an IOU saying, hey, in 3 years, I'm going to, pay your money back. Mm-hmm. So this operates the same way, right? This is just a IOU between you and the large financial institution. So you just want to be comfortable with the institution that you're doing business with, which again is not unlike, any transaction we have in finance, right? The reason why you hold your money at, a bank, let's say Wells Fargo as an example, or even your local credit union, like I alluded to before, the reason why you're holding it there is because you have trust that the money's going to be there when you need it, and the government has put in, guardrails to say, hey, these banks are responsible for holding this money. So it operates similarly to that.
All right. So now that we have a general understanding of structured notes, are there certain types of structured notes available?
Yeah. So again, running along kind of the same theme that we've been talking about, you can really cater these structured notes to do really whatever you want, right? You can follow whatever industry you want. They can operate in different ways depending on how you would like them to operate. So it's nice in the sense that depending on what you're trying to accomplish as the customer, as the client, you can customize these structured notes to tailor exactly what you're trying to do. So let me give you a great example. If, for example, you said, hey, I want to collect, income or dividends or interest from my investments because, you want income as an example, right?
Okay. Right.
Well, within a structured note, you can structure it in a way where they say, remember, we have those protections. So they say, hey, we will protect your principal, for the first 30% of downside, let's just say as an example. So we'll protect your principal. If, $10,000, let's just use that as an example. We'll protect your $10,000. We'll hold it for 3 years. And so long as, the market doesn't go down more than 30, 40, however we kind of structure it, they will pay you interest over that time. And the interest varies based on, a couple of different factors. But, sometimes folks can, collect, between 10, 11, 12% interest per year on these structured notes, which is oftentimes, a lot more attractive than, your local bank CD rates, as an example.
Sounds pretty good.
Yeah. So that's one side of the coin if you wanted to, get some income there. The other side of the coin is there are structured notes that are built solely for growth, right? So they say, remember we have, some sort of term, 2 or 3 years, depending on the way we structure it. So they might say, hey, let's use the S&P as an example, S&P 500. They say, hey, if the S&P 500 is up, then we will give you, some of the up, right? So if it's up 10%, maybe we'll give you 9% interest over that time frame. And then in exchange for that, you get some protection on the downside. Going back to our previous comment about, the way that these work, they might say, hey, we'll protect you from the first 40% of downside. And in exchange for that, you'll get some of the up. So it provides those protections, and it still allows you to have some exposure to the market or, an individual stock, right? So that's really the two ways you can kind of structure them, depending on, what you're looking for.
Okay, so we discussed general risks and benefits, but what are some things that people should consider before potentially investing in structured notes?
Yeah, so first of all, you want to consider what your overall objective is of your investments in general, right? So this is a conversation that, as you know, Ron, we have with all of our clients, right? Which is, okay, you save this money, we're approaching retirement here. What are we really trying to get out of this money? Is it income? Is it, passing money to our heirs? Are we, putting aside some money for long-term care? So the first, step is to figure out exactly what our objective is, and then once we know that, we can say, okay, we can whittle down the investment options and say these are the best, investment options to achieve whatever that goal is. Mm-hmm. Combined with that, right, we want to figure out, okay, what is your risk tolerance as you approach this, new phase of your life? I made the comment before that, with a lot of our clients, because we specialize in folks, entering retirement, we're not 30 anymore, right? We can't necessarily weather, a big, market event or economic shock or something like that. So how much risk are we comfortable with as we approach this, new phase of our lives? And again, that all helps us, make these, investment decisions, not only with structured notes, but really your overall plan in general.
Well, the crazy thing is, we talk about this a lot on this podcast, is that when people first come to see you, sometimes they are absolutely stunned to find out how much risk they have inside their portfolio. And if that's the case, you want to change that for sure.
Oh, 100%. And I'm glad you brought that up because oftentimes, folks, when you're saving in your 401k or your TSP, if you're in the federal government, most of the time the money is just coming out of your paycheck, right? It's going into the 401k, mm-hmm. and you're rightly told, hey, don't look at it. Eventually it will go up. Don't look at it too often, right? It'll give you some anxiety.
Yeah.
But again, it's largely on autopilot for most of folks' lives. So as you approach retirement, it's really kind of a key time to take a look and say, okay, I've ran the race. That's kind of a common theme in our office, right? We've ran the race. We've saved. We've worked hard. We've put that money away. Now, really, you want to understand where you are and make sure you're making pertinent decisions based on that.
Yeah, absolutely. Well, Chase, what's the future outlook for the structured notes? What's the future outlook for the structured notes market?
Yeah, so it's really interesting, Ron. The structured notes in general have been around since the mid 1970s, and right now, as of this recording, so we're recording here on June 30th, 2023, structured notes account for, almost $3 trillion of the, overall investment landscape out there. So it's a very big part of, investing in general. Now, a lot of folks here in America, in the United States, haven't necessarily heard of structured notes. It hasn't really been a big theme for investing here. But in Europe and in Asia, people have been using structured notes for a very long time, going back to, like I said, the mid-'70s. So what we're seeing is, a lot of people that, want some of these protections as they approach retirement are looking to these structured notes and saying, hey, this might be a good fit because, I want those protections as I move through retirement. Now, the regulatory landscape, not only with structured notes, but just, investing in general is always changing, right? It's always kind of a moving goalpost in that respect, right? So that's why, to kind of drill the point home, right? That's why we always encourage, hey, get with a financial professional who is constantly monitoring, the regulatory landscape with all of these different investments, just to make sure everything that you're doing is, by the book and according to, all the rules that are out there.
A recurring theme on this podcast is get with a financial professional, and
That's right.
I would suggest very strongly you get together with Chase and Dave Lopez at ILG Financial. This may be a new concept to a lot of people listening to the podcast today. Structured notes really don't get talked about a lot out there in the financial market.
That's right. And the reason is because they're not offered in the 401k, right? So if that's really, a customer's only exposure to investing, that's really all that they know. And, it doesn't make for, good marketing material on TV, right? So on TV, we often see, the market's up, the market's down, and, the headlines are very, very skewed that way, right? But there's a lot of, neat things that are going on underneath the surface that a lot of people, aren't talking about. And this just so happens to be one of them. So to your point, if you want, any more information on, a structured note, what the risks are, what the potential benefits are, if it can fit inside of your financial plan, definitely recommend, giving us a call and we can kind of walk through that.
Well, Chase, I appreciate your taking the time to talk to us today. I understand structured notes a lot better, but I think I still need to have a longer conversation with you about all the specifics, and I would imagine a lot of other folks are too. But thanks for being with us.
Oh, Ron, thank you again. It's always a pleasure to hop on the podcast with you and talk about different things. So, sincerely, thanks for taking the time yourself.
Ladies and gentlemen, that is Chase Lopez of ILG Financial. Now you are one step closer to learning what a customized retirement strategy can do for you. And income, legacy, growth, it's all right here at ILG Financial. And it's about helping you plan for retirement your way so you can achieve your financial goals. Call ILG Financial at 540-720-5656, or you can go online to ilgfinancial.com to learn a whole lot more. And you've been listening to the ILG Financial Retire Your Way podcast. Have a great week. Join us again next time. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.